You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Hey everyone, welcome back to another edition of the Systematic Investor series, where each week we discuss and debate what's going on in the world of rule-based investing right now. My name is Niels Kostrup-Larsen, and I'm excited to welcome my co-hosts Jerry Parker and Moritz Seibert. Hey guys, how are you?
Great.
End of the month, end of the week. So something to look forward to coming up very shortly. But since it is end of the month, why don't we talk a little bit about the month of September to kick things off? If I maybe start with you, Moritz, how did you see this month?
It's been a good month. Up a bit more than 3% actually. So one of the better months this year. Short on gilts. Actually got a bit of movement in the portfolio this week. A bit longer now on natural gas. Position on the 10-year notes turned around. This is now short. A bit longer on the equities. A bit more short on the pound. And those have all been good markets for us to trade.
Well, I mean, I guess the interest rates are hovering around some interesting levels at the moment, certainly from an historic perspective. And I saw a few headlines during the month where people talked about the decisive break of the yield to the upside. So, and clearly, certainly we on our side have been benefiting from the short side on interest rates as well, as you just said. So I mean, we're not quite as high as you are, Moritz, but done pretty well this month as well. So it's nice to put another black number on the board, even though people still complain about this being a difficult year. But at the end of the day, we had one difficult month this year, and the rest has been pretty standard for trend followers. What about you, Jerry? 10-year notes, interest rates in the US, is that a focus area for you?
Oh, definitely. Watching those rates and seeing what's happening and seeing the downtrend sort of continue. We held some positions and some solidly profit, and some we held through the small loss and didn't have to get out. So I like those markets, but I do think that historically I have traded them maybe a little too large, and I think I'm going to reduce my exposure because they are so correlated with each other. I think there's more diversification to be found in the stocks and the commodities in particular. So I don't know if
I was just going to say, what has been your general sort of allocation to fixed income on your side?
Around 25%.
Okay.
And
okay.
I think we're just exploring, can we basically get a better, more diversified portfolio by lowering that a little bit? There is some differences there, but they're all pretty coordinated these days. It's interesting to see, maybe we'll see the JGB come back. I've been reading articles that it's sort of dead. It trades every other day or once a week, and but it had a break recently, and maybe it's still on our list, and we're going to take those trades if the liquidity gets back in there. So maybe we'll actually get a downtrend in the JGB. That would be pretty unique.
I think that's an interesting area, right? Because we talk about the discipline, we talk about, being systematic, you have to follow your system 100% and all of that. And, JGBs is a perfect example, right? Because how many times over the last, 10, 20 years would systems like rerun, that we run, not have tried to go short? I mean, there's probably been quite a few times, and it's always been with a bad outcome. And then, as you say, at some point we're going to get that break, and it could be a tremendous trend to the downside. But it's the discipline of keep doing it. And I think, again, we talk a lot about the diversification benefits, et cetera. But when you have just JGBs, for example, as one of many, many markets, it's not really sort of a big tragedy if you lose even 10 or 20 times in a row. I think a lot of people miss that, and they end up with too concentrated portfolios. So when they do take a loss in a market, maybe 10 times in a row, they think there's something wrong with the market, and they stop doing it right before you get the next big move. Do you trade JGBs, Moritz?
Yeah, we do. We've been alongside, and then we had that breakdown a couple of weeks back, and it's now a short position. Sure. Not very large though, but it's short.
I think we would like to make money and be in the right positions, and only be in the trend, the ones that are trending the best. But it's really only in hindsight that that, and so I think it's perfectly appropriate to build your portfolio from the ground up using the correlations and the liquidity and the most diverse portfolio you can. And then you look up and you're only short basically the US, and Australia is sitting there. JGB is not doing anything. Europe is not really in a big downtrend. You're like, golly, why can't I figure out I should only be in the US? But then when it rallies against you, you're like, oh yeah, thank you. That's why I have diversification. So we tend to second guess ourselves after the fact. But I remember in the late 90s when the only index moving was the NASDAQ, and I just had a project to figure out how do I come up with a rule that makes sure that I'm only in NASDAQ, if it's, or in the strongest market, and it's just impractical and not something you can do. So it's fine not, to have some powder on the sidelines waiting for Australia, Europe, and Aussie and Japan to show the downtrend as well, and just sit with your U.S. short interest rates. That's totally fine.
Yeah. I mean, with interest rates, I agree with you that, for many years it's been a very correlated sector. Although I would say nowadays where you clearly have three different, goals for the three major central banks. Clearly the US has always been very concerned about unemployment, Europe, it's inflation, and Japan, they just want to get something going over there, I guess, both on both fronts. So they have very, divergent policies, I would say, at the moment. So maybe we could see also, even within fixed income on a global basis, a bit more divergence and less correlation concentration as we've seen, which would be good generally for the portfolio. But clearly you're also looking to maybe allocate something, away from the fixed income sector, it sounds like, Jerry.
The correlations are very tricky. I remember over the years in 1990 and 1984 and 1990, heating oil doubled in price and crude kind of sat there. And they're really highly correlated markets. 1987, silver doubled or tripled, and gold kind of went up a few bucks. And so it's really difficult to navigate. You don't want to, they're different markets. You should trade both, but they are sort of correlated. But then you can, what trend following does is it takes advantage of things that have never happened before and are unlikely to happen. So you don't want to ratchet down the position so small that you don't pick up, some profit when crazy things like heating oil doubling because the New York harbor is frozen. And of course, it doesn't impact crude at all. So it's a puzzle, and we get paid for solving or trying to solve these puzzles.
Yeah, no, absolutely. I think also,
I agree. It's also one of the reasons why you'd be trading Brent and WTI at the same time.
Indeed. Yeah. It kind of reminds me of another conversation that I've had recently with some investors, and on the general point about diversification, I heard you earlier this week, Jerry, on another podcast, also talking a little bit about the difficulty for people to embrace what we do enough to really make a meaningful impact on their portfolio when it comes to diversification, really. But I think to some extent, and I saw this in the newspaper in Ireland the week before last, about how they had become so cautious that they were almost afraid to take risk. And it kind of, resembled a little bit the question about, are we getting too overly diversified as investors because we don't want to take any kind of risk anymore. But of course, it's not really the diversification the three of us are talking about, because we talk about truly uncorrelated markets, while I think a lot of investors think that if they buy 100 different stocks, they are diversified, which we would probably argue they are to some degree, but not to the same degree as including, commodities and all the other wonderful markets that we trade. But it's an interesting conversation that seems to come up from time to time on my travels, at least. What else are you seeing for at the moment? If we're talking about, do you want to go into more about this, Jerry, about the fixed income side, or anything else you want to bring up?
Well, I enjoyed one of your other podcasts with Art Bell.
Oh, yeah.
And I saw a quote on your LinkedIn page today, and I thought it was worth discussing.
Yeah.
And here's a guy who is the accountant for the CTA industry for 30 years and very experienced and knowledgeable, smart person. And his quote is, "I would only suggest manage futures for a larger portfolio because you don't want to put all of your money into futures." And I said, what a sad statement that is. And he has the experience and the knowledge, to back it up. I don't know what his specific comments would be to expand on that, but I thought it was just a very sad state of the CTA industry that this would be somewhat true from his point of view. And I don't doubt that there's merit. How do we as a CTAs have all the markets possible at our disposal? We have this great systems, the trend to manage these markets in a conservative, risk-adjusted, risk-controlled way, and also deliver up, good performance. And we are telling everyone, and always have pretty much, no one will expect you to allow us to manage very much of your portfolio. And I think this would be something I think that probably we should think about changing over time. I certainly think that over the years, due to the high cost of some of our funds or the high fees, high leverage, and then frankly not having enough single stocks, it's perfectly reasonable that this is the way clients have felt. We've been turning them off, and for these reasons and others probably, that are trying to get 5 or 10% when to really impact people's portfolio and to deliver some sort of alpha during tough periods. We should be managing more and more stocks, because that's kind of what people like and expect their portfolio to look like. And I think, Abbey Capital is doing some of that with their new fund. Milburn has had some stock exposure long only in their fund for a while. It's been very successful. And maybe the next step is a portfolio that created by CTAs with lots of good stocks and longs and shorts and trend following. And then, maybe a few currencies and commodities as well, and interest rates. So I just think that was a shocking statement, that hopefully in the next 30 or 40 years, we can do better and maybe have another fund or product that people would want to buy and sort of meet people's needs better than we have over the past 30 years.
What are your thoughts, Moritz?
I'm not sure why he said that. I was just thinking while listening to you guys, there have been those, Refco, MF Global, Peregrine, about the safety of clear transactions, including futures transactions. And maybe you've read that, I think it was last week, or maybe it's now 2 weeks ago. There's been another incident over here in Europe, actually, on, I think, NASDAQ OMX or NASDAQ Nordic, where they had a large trader trading Nordic power contracts, power futures. And I think it resulted in a 100 million euro or dollar, I don't know, 100 million loss for the clearinghouse. I was kind of like surprised by that. It's like, how how is that still possible in this day and age? See what I mean? I would have thought that really with all the technology that's in place, monitoring clear transactions, the margin processes, for some of the firms being real time, how can something like that happen? I was kind of like disappointed that it happened. And I was, guessing that, okay, maybe on the back of that, you'll have some news come up saying, well, don't put too much money into those type of managers. They're trading futures, and your funds may be gone because the clearinghouse breaks down. I don't know. I'm not sure if you read about that or if you want to comment on that. I just found that interesting that it happened again.
I mean, I think I don't know all the details, and clearly, I'm not an expert in that field, but I do think that you are referring to a Norwegian energy trader who were trading some, spreads between Norwegian electricity and German electricity. And from what I understand, I think the breakdown really starts from the fact that I think he was clearing his old trades. So, which is a weird concept, because it kind of goes against what we're trying to promote with futures. And this, I think we should be clear that this was not futures contracts that he was trading, as far as I'm aware. So, but I mean, these things are never helpful. And again, I mean, we have an industry which has proven to be able to navigate these markets from all sides, including regulation and so on and so forth. And, so hopefully people will still look at our industry and say, well, I would rather be over here because it's proven to work. While, other markets, maybe more exotic markets, where you don't have the same kind of history or maybe even the same infrastructure when it comes to the clearing side, that's where there's still accidents that happens. So, yeah. But I agree with you, Jerry, in general, from what you were saying before. I mean, I think it is, I wonder, I mean, is it just because we talk about our industry the way we do? I mean, is it what we call ourselves, managed futures, trend followers? Or, I mean, I know trend following is a good word because that's what we do, but I'm sure you remember that there were times when people were kind of changing the narrative around what they were doing, certainly in the 90s when CTAs we weren't doing so well back in 94, and people were more, or maybe we should call ourselves a hedge fund, and then they were talking about that, and then they went back to the term CTA, and I wonder, I mean, what if we were just talking about what we do as a long short portfolio? Long short equity seems to be pretty popular, and maybe we're just long short futures. But I agree with Jerry. I mean, what we do should be applied to a much larger part of the portfolio, and we shouldn't be fighting over, can we get into a 5% allocation, and then people expect us to do any meaningful, protection or non-correlation for the 95%. I mean, it's kind of ridiculous, really. And this goes back to this point about, are people over diversifying to some extent since they're only willing to put 5% allocation in this space? I don't know. Any thoughts?
A lot of thoughts. One of the things that I find is that in our mutual fund, we are used by other RIAs who are trend following the equities and bonds for their clients. They allocate 5 or 10% to Chesapeake for the alt piece, which is silly. I mean, here I am stuck with 5 or 10%, and these young guys starting up a business, they, trend following is good. It's accessible. It's a way to get your hands around the risk and keep clients from losing too much money. And so they are managing 90% of the assets with a trend following methodology, equities long only probably, and cash ETFs or whatever, and then allocating to the trend following expert 5 or 10%. So how do we get in this situation?
Right.
it's somebody in their late 80s came up with an idea of the efficient portfolio by saying, here's what happens when you add 5 or 10% of CTAs to the bonds and stock portfolio, and you create this efficient frontier. And then we just haven't stopped saying that. regardless of how it hasn't worked.
Yeah.
And no one said, well, what if we trend followed the stocks and the bonds and added crisis alpha there? And then we threw in a few currencies and commodities as well for more diversification. Is that something that would even be better? It's an irrational desire to have 80% stocks in your portfolio. I get it, but it's also kind of not that smart to refuse to play along, at least with one of your programs or funds. You say, okay, if that's what you guys want, I'll do the best I can with that. But to give me this dysfunctional portfolio of passive longs in the stock market that is going to usually be about an 8% average return and a possible 50% drawdown, and then say, here's 5 or 10% of your for your program, can you provide crisis alpha? That makes no sense to anyone.
No. But maybe it's just this human bias that nobody wants to be, failing unconventionally. They would rather fail conventionally. And so if everyone else is down that month, well, then it's okay. But it is sad because a lot of these people are pretty smart people. But it does remind me actually about a conversation I had with a group, I think 3 of this sort of the larger US consultants last year. And I think it was Adam Duncan who said, when we go in and if we explain to clients who are predominantly equity based what we believe the true allocation to trend following should be, there's no chance that they're going to go for that number because they actually know and the consultants from all their analysis show that it needs to be a much bigger allocation than the 5 or the 10%. But they just won't get through with that. Anything on your side? Any thoughts, Moritz, on your side?
I just agree with that. I hear people say that they have 5% allocated to trend following programs, and it's hard to imagine how that is moving the needle in any way on a larger portfolio. So, kind of like at a loss as to where those 5% come from. And I agree that, if you really want to get the benefits from an allocation, that it must be larger than at least 20% to even get the positive impact on the portfolio that we want. And that has nothing to do with, crisis alpha, whatever that crisis alpha thing is. I'm not sure what it is as far as I'm concerned. I don't connect trend following CTAs with crisis alpha in any way. They're at least not the way that I trade or I think that we trade. Just because of the fact that we're not trading those fast short-term systems, which I also don't want to trade because, well, I haven't found a way to really trade them in a profitable way. So it's just no way for me to provide that crisis protection, that hedge with the way that I trade. The only thing that I can offer is, the pain and the drawdown and follow the system and do the right thing in the long term. But I don't have a crisis hedge in any shape or form. And I don't think you don't get that with a 20% allocation to CTAs. Definitely don't get it with a 5% allocation.
No, I think it's up to people like us and hopefully others to change the narrative. I really think, as Jerry was saying, it's a narrative that started, 30, 40 years ago, and it just hasn't changed.
Yeah.
It used to be... you would see in materials, here are the S&P's 5 biggest drawdowns, and then here's how CTAs performed during that period. Well, it sort of changed to, on February the 5th, 2018, how could you possibly lose money? Why do I own you if you lost money as well? Not only did we lose money in stocks, we lost maybe even more, percentage-wise in currencies and commodities, let's say. So that's right. It's the optimal portfolio. Our friend Mike Dever sent out an email 6 months ago, and the title of the email was CTA's the perfect hedge. And I wrote back, Mike, the perfect hedge or the perfect portfolio? And he was like, oh, I'm so mad that I was so wimpy. And that's the truth. It's the perfect portfolio.
Yeah.
the best we can do with longs and shorts, currencies, commodities, interest rates, tremendous diversification and risk control. So yeah, it's really the perfect portfolio, but you're out there saying that when the industry and other people are saying you're going to blow our 5 or 10%. If you don't, it's going to be 0% if you try to strike out and do something that's actually the honest truth. I went to something called the Evidence-Based Investing Conference in New York last year. And as if all the rest of us are not evidence-based, it's kind of a little insulting term that has sprouted up amongst the passive people. And Meb Faber got up on the stage. He's sympathetic and a trend following, and a sort of a trend follower, I think. And he got up on stage and they talked about disallocation between traditional assets and CTAs. And he basically said, yeah, my analysis is that CTAs should be 50% of the allocation. And can you imagine if you were running the evidence-based investing conference, that right then you would have had to stand up and say, stop right here. This is an incredible thing. It's either not true or it's the most incredible thing I've ever heard. And that you're telling all of us we should have 50% of our assets in CTAs. And of course, no one said a word. It just passed on and it was just left. And so that's another way that things sort of play out is these things are never denounced as not being true. They're just ignored.
Yeah. No, it's the same thing about, generally with white papers. I mean, there's never been a white paper to basically refute what Lindner came up with all those years ago. I mean, but still people choose to ignore it, which is interesting. So we'll keep fighting for the 5%, but maybe one day we'll get to 6, 7, 8, or even 10. Who knows? Any interesting news before we get to your top tweet, which from now on will be the top tweet? We could talk about why that is in fact going to be the case. But any other news that you guys came across?
Nothing that interesting really this week, I must admit.
Anything on your side? Or should we just jump to your tweets, Jerry, which are always interesting and we can debate them a bit?
Yes, I am very interested in being aware of what's on people's minds in the Twitter universe and try to interpret it from a trend, systematic point of view, and how I see it and how it relates. The long-awaited, anticipated Howard Marks memos. People seem to love these things, as do I, and one of them came out this week. And he's a fundamental value manager, I guess. And then it's just amazing how over the years I have just really found a lot in common. I don't think he likes systems or trend necessarily, but his worldview on investing, I find that I have a tendency to agree with it sometimes. And so I looked up on my Twitter, and I can find a list of the tweets that I have posted that other people liked the most. Maybe not mine. I can never predict these things. It's hard to understand some of the things I think are amazing. Sometimes my pinned tweets get 5 or 10 likes over a 6-month period, and I just think it's the greatest thing ever. But this one was number one, Howard Marks, and I pulled out the quote, investors should favor strategies and managers that emphasize limiting losses and declines above ensuring full participation in gains. You simply can't have it both ways. And so a lot of trend followers, people who are interested in like trend following, do follow me. I can definitely tell. So I thought that was a very interesting quote. It's something we do 24/7, every day of the year. That's what we say. That's essentially what we're doing. We're putting diversification, liquidity, stop losses, risk as a paramount idea in our trading and our systems, and hoping, that this is not going to prevent us from participating in some long-term trends. And it's just a given. We're not going to sacrifice or compromise with taking on the type of risk that one would take maybe with buy and hold, or no stop losses, or no trailing stops. But I did sort of pick up in this probably a little bit of counter trend thinking that I try to discourage, which is CTAs and trend followers in general should embrace stock market uptrends. And everyone seems to be very aware that stocks are going to sell off soon, and when they want to make sure they teach everyone a lesson and be on record as saying, hey, I kept telling you guys that the stocks were going to go down. And of course, most people have been saying that for a number of years now. So I don't think it's a good idea to, I don't think there would be that much interest in the energy markets, for instance. That they're our markets. That's our claim to fame, the commodities. But in the same way, we should be sort of a trend follower and not badmouth really nice stock uptrends.
Do you think so? So, I mean, I agree, but I also think it's, again, these human biases that we also as trend followers to some degree, at least in our communication, because clearly there seems to be a correlation with equity market troubles, and then usually 6 months later, lots of inflow to CTA. So I can understand why CTAs think it's great when equity goes down, because that that normally means that they can go out and raise more money. So, but I completely agree with you. Why would we be biased towards an equity sell-off? Because actually, the last couple of years, as an example, shows that we as an industry can really take advantage and deliver very strong returns from that sector in particular. But again, it's just one sector and it doesn't work all the time. So we should have no bias. I mean, we should love all the markets we trade, for good and for bad.
Yeah, and I don't think, did he say you can have it both ways? I'm not sure if I understood that correctly. Limit. So when you limit to your losses, then you also have to limit your upside. Is that what he said?
I think he's saying be diversified, especially now, and don't worry about not fully participating in the S&P gains from here on. And that's what we do 24/7. We don't just invest in the S&P. We invest in all of these different markets, long and short. And we certainly believe that we're not making a performance compromise. We think that all of these trades have the same potential profit, whether it's stocks or bonds or currencies or commodities.
Exactly.
Even though it doesn't look like it over a long period of time, they all make the same amount of money. Certainly in my first 10 or 15 years of trading, at least, we made more money than the stock market. So this too will pass. We think, we hope. It does sort of sound like a contradiction, because I was just saying earlier, let's trade more stocks. And the only reason I say that, I don't think it's optimal to necessarily trade more stocks. I wouldn't advise trading more stocks than the numbers say we should. How much diversification are you getting from your stocks? Then that's going to determine your positions in all the sectors. But no, some people want more stocks, and in the time to prepare for this sell-off or these issues is not just now, which he's insinuating. Oh, now it's really overvalued. Prices are crazy high. I mean, we start, that's just what we do. You should always sacrifice the potential upside in any one market or sector and default to more diversification.
And
Absolutely.
we're in that game of, actually trying to get it both ways, right? We're limiting our downside, cutting the losses, taking many losses, but in return for that, we're hoping to get unlimited upside. Where does the price go? To the moon. maybe. So just stay long for as long as you can. This is, it's not an opinion contest. If you just follow that price, you just stay long until the trend changes. So we're looking to get it both ways. Very good upside moves, many small losses, and the winners pay for the losers.
And it's kind of like sometimes that, people just don't want to accept the facts. I mean, take your track record, Jerry. I mean, I don't know the stats precisely, but it's something like, in 30 years, you've had like 4 down years. I mean, who wouldn't want that? I mean, it's crazy. And yet we seem like, whatever we present as facts and numbers and audited track records, it's like, yeah, but, there's always some kind of excuse for why they wouldn't want that or take it as a really, really strong investment case, investment strategy. It's interesting. I'm intrigued by those forces that are so strong in parts of the investor community. I think some people are changing, and certainly over here in Europe, I do see people embracing this, but it's slow. It definitely is. So, anything else? Any other tweets, Jerry, you want to bring up before we maybe do some Q&A? We've got lots of questions coming in, which is great, by the way. So if you're out there listening, keep them coming. Send questions to info@toptradersunplugged.com, and we will do our best to answer those. But anything else, Jerry, you found interesting in Twitterland?
I enjoyed kind of a funny tweet. I retweeted this recently. It was a favorite. More fiction is written in Excel than in Microsoft Word. And I think hopefully we're coming across as, just the biggest believers and lovers of backtesting and research and systems, on the planet, but we're also understanding the limitations and how careful one must be and humble with your numbers. Many times I've left the research meetings over the past 35 years and been so excited and just could not contain myself that we were going to make these dramatic improvements in performance. So then, over time, you sort of become more mature and understand that what you should expect from as wonderful as the analysis, the Excel or the TradeStation or the MATLAB or whatever you've graduated to over the years. It is. We do know that there is a lot of fiction in even our numbers, and so we've been chastised appropriately over the years to have a more reasonable expectation.
I think that's a great. I think we could do a whole episode on that topic. I think that's a very, very interesting topic, and also something that somewhat frustrates me from time to time, because I see so many newsletters being sold where once you read the small print, it's just a backtest that they claim is, gonna solve all people's problems. And unfortunately, many investors, go for it and spend a lot of money subscribing to these newsletters, which are essentially just, and I'm interested in why that industry is not regulated harder compared to our industry. Because a lot of claims are being made about performance, and a lot of that performance isn't real. Yet it seems to be, not falling under the radar of people who tend to look at these things. Yeah,
I agree. I saw that quote also, and I liked it. So we have the same taste there. I really love that quote, and it is true. And also what you're saying, Niels, is true. I mean, sometimes I'm, kind of like getting almost angry when I see those fact sheets and they apply, say, a long-term moving average to just the S&P or an equity index. And then there's a very interesting choice of starting point. And the starting point is like 2007, right? So right before the crisis. And then the strategy is you go out of the market in the downtrend and you're invested if the market's in an uptrend. So the thing starts and it's like immediately flatlining while the S&P is like heading down 50, right? And then come 2009, the system gets long again and you're participating in the upside, and maybe in the meantime you've had 3 or 4 maybe changes in signals. So sample size is kind of like 3, 4, something like that, right? So really nothing. And it looks great on paper, but really it's completely meaningless. But it looks great.
It does. It does. Anyways, why don't we take a few questions before we end our weekly conversation this week? Are you up for that?
Sure.
Good. So there's this is from Craig, and Craig wrote to us a few days ago. And there's a few questions here, but I'm just going to do 1 or 2 of them because there are many other people who wrote in. So I want to try and get to a few. He has some very kind words about the new podcast. So thank you for that, Craig. And then he asks. So he actually talks a little bit about, I'm just going to jump into one of them. He talks a little about the greatest concern from legislative and regulatory standpoint at present. And so we don't talk so much about that maybe. So maybe we can just give our thoughts about what we worry about. I mean, if I can just kick it off, I mean, I think going back to Arthur Bell's comment, I mean, I agree with you, Jerry. I mean, one of the things that is great about what has happened in recent years with the 40 Act funds, etc., is in fact that now more people can participate in these strategies, and they're probably the people who really need it the most. I mean, the very super high net worth individual and family offices, they know how to navigate, different correlated assets and so on and so forth, or they should know. But the more traditional private investor benefits greatly from having access for the first time in a long time to some of these strategies. So my concern personally is if we are getting new legislation that will prevent that from continuing to grow, even though I picked up something in the news this week or last week, and maybe you know about this, Jerry, talking about that in the US they were looking to change the accredited investor rules and maybe make it a little bit easier for people to become classified as an accredited investor. Don't know if you saw any of that or have any other thoughts about these things that Craig is asking about.
No, I didn't see that. I saw that they're bringing back the idea of measuring the leverage used by mutual funds, and it's going to have a big impact on futures traders and futures traders who trade markets that with low volatility and adjust
low size,
adjust the positions because to a higher level because the vol is low. Yeah. And this could give an impression of high leverage. And this has been, I think, bounced around a couple of times over the years. So maybe that's something that I'm hoping that the really big funds like AQR will just take care of this for me, so I can just move on to other things.
I was just about to say that. Yeah, I think we're all cheering for them at this point. On that point, that's for sure. Anything else that you see in terms of when Craig asked about concerns and anything on your side, Moritz, that you see over here in Europe?
Not that much really, and I'm not sure if I'm the right person to ask. Sorry, I can't really help there. I mean, we're regulated the way we are, and it's a lot. Let's leave it at that.
Well. Which is another thing I think people should appreciate more because we've always been regulated pretty hard as an industry compared to other strategies anyways. One more quick question, and we can make it general, I think, but another one from Craig is just a little bit about where we spend, and I think we should talk about this maybe as firms rather than individuals because maybe it's a little bit misleading since, it's not a one-man band, but where we typically spend our time doing a month, trade execution, analysis, research, et cetera, et cetera, et cetera. What would you say, Jerry, as a firm, in terms of time spent?
Time spent thinking and strategizing and looking at the markets and trying to get some new ideas. Everything is, the trading and execution is automated. 90% of our time is spent. 10% of our time is really only spent on. We only spend 10% of our time on what creates the P&L. So we're very fortunate in that regard, and everything else is regulations and admin, lawyers, accountants, marketing, sales. But my main job is just to look at the portfolio from a high level. Are we missing anything? And try to come up with new ideas. I'm good at new ideas and big picture.
Yeah. How about you, Moritz?
Daily processes aren't, they're automated, and maybe that's a 10-minute task. Hitting buttons, sending out orders, producing orders, sending out orders. That's all automated. Getting fills back, running reconciliations, all of that. In today's day and age with technology, that's no longer a problem. And really, trade breaks, there aren't that many. So kind of like, the daily operations, they're very unexciting, as I think they should be, which leaves a lot of time thinking about new things. So interesting areas for me are, looking more into synthetic markets, that is spreads, those type of things, creating markets which maybe other people don't really look at that much, which are less crowded and therefore potentially more interesting to trade, and also diversifying within the portfolio. So it's research, and like Jerry said, coming up with new ideas, thinking about things.
Yeah, that's interesting. Actually, I find it very interesting that you mentioned that, more. It's about thinking up new kind of markets or synthetic markets, because I had a very detailed conversation with Harold from TransTrend about that, because that's something they embraced many years ago, and where they've evolved that to. Just from our point of view, Francois, I would say that as a firm, we probably spend our time equally among sort of 4 key areas, which is research, and also the way we allocate resources in terms of staff. So probably 25% are focused on doing the research, and another 25% are focused on implementing the trades, because as a firm we want to have 24/7 staff for execution purposes. And we're a little bit old-fashioned maybe compared to other people, because we still like to see the trades before they go into the markets. We don't just let the systems go straight into the markets without any human being overseeing that. So maybe that takes a little bit more human resources. And then you have your business management side / operations, and then you have also resources allocated to looking after our clients and making sure that they have and get what they need. So that's how we do it on our side. So thanks for those questions, Craig. Then Francois has some questions for us. Also, he starts out with some very kind words, so thanks for that, Francois. And I think it ties back to a little bit about what we sort of touched upon maybe today and previously. He has one question. He says, how long did it take before you stopped modifying and religiously follow your system? So maybe I'll start with you, Moritz, on this one first. And what say you to that question?
Great question.
It is a great question, yeah.
Religiously following the system. That's the goal.
It's like being under oath now.
You're under oath now, exactly. So It's been quite a long time for me that I've disregarded a signal or trade. So that's I think is good news. It's good news for me. So tap myself on the shoulder for that. But I definitely cannot say that it's always been like that. So definitely had episodes where I tried to second guess a trade or a signal and not take it, or take it in a different way. And maybe 10 to 20% of the time that was the right decision to do, and 80% of the time it's definitely been the wrong thing to do. So getting to the point where kind of like you switch off the brains, stop thinking, and just follow the system. I think this sounds hard, but that's how it should be. And getting better at that. And like I said, haven't really overwritten a signal in a very, very long time now. Now, as far as not modifying the rules, I definitely cannot say that I've, stopped changing the system. Like, you do new research, you find new things. I mean, at least I think that, I come up with some new good ideas and things that I like to try out, and then I follow them paper, then I trade small size, and eventually implement it if I believe it's a good thing to do. So the system is evolving, and the rules don't. There are some ground trend following rules that never change, but some of the stuff on the edges, maybe some new exits. Those type of things that continues to change.
Yeah. How about you, Jerry?
Yeah, so I wouldn't say that making tweaks and certain changes, uncovering deficiencies in your system is not following things religiously. I'd say when you finish making those changes, now start following them religiously. And I think that's the way to do it. I do think that one should count the cost of frequent changes, or changes that may not even seem that frequent. You can zig when you should be zagging. I've definitely experienced that the old systems would have done better than the new ones, at least over a short period of time. I'm always, almost every single change or tweak we've made, I've just walked away thinking, that was available for me to uncover many, many years ago. It's not like I researched something and I found it and it's new. No, it's sort of like I didn't fully understand, how deep and profound some of these ideas can be, and I didn't incorporate them into my approach, but it was staring me in the face. I just needed to figure it out. And a lot of things too, I have not uncovered until later dates because I didn't think it was possible to really fix it. My heart was not into, there is a solution to this. If I just keep digging and digging, I have to convince myself, look, keep going. There could be a solution, a better solution. So, but I think I think clients want evolving and change and improvement, and please get rid of February of 2018. And it just doesn't work like that. There are huge changes in cost of changing. And but I really like the idea, and this is the thing that I think our firm we've been very slow over the years because there was the top 10 trend following commandments that we just refused to break. And the tried and true classic trend following, we just wouldn't even explore it. And so I think that is important too. What are the givens that you're not ever going to, counter trend trades, profit objectives, trading markets with different systems, or longs and shorts, trading those with different systems. These are things that when you write them down and you say, these are what I really believe in, then it really limits your tweaking and research. Yeah.
Yeah, no, I tend to say when asked, I think that, investors, they do want you to evolve, but they don't want you to change. And that is a balance that we have to deal with. But I would say from the history, since I don't work on the research side, so I can't talk about the same things as Jerry and Moritz did, but I can talk about the firm and how it was when Bill Dunn started, and it was very similar to what Jerry said. I mean, there are just a lot of things that you couldn't do if you're a true trend follower, and I think that is what Dunn has always stood for. And in fact, in terms of major changes, no real major changes were made from 74 when the company started to around 2006. So a pretty long period of time. On the other hand, since then we've made 3 or 4 major changes to improve the system, and as long as we can find those things, because people have to realize every time you make a change, you have the chance of getting it wrong. So change in itself is not what you should strive for. Yeah, but I do see people who make changes all the time, and I've often wondered, how the hell do the clients figure out what they bought if every quarter you get a message saying, "Whoa, we found this new thing and we're gonna put that into the portfolio"? That makes it very difficult. Anyways, let's move on. We're already almost at the hour mark, which is great because we've got a lot to share and talk about. But maybe one more question from Francois for this week. He says, could you please touch on the pros and cons of using futures versus ETF? Brackets, liquidity, markets, fees, margins. Maybe just a short comment from you guys. Any quick thoughts on pros and cons, futures versus ETFs?
Well, it depends. Maybe I just start.
Well, in my opinion...
Now I get both thoughts in the same time. Let's come to you first, Moritz.
Yeah, I think we touched on that already in another episode. Some brokers allow you to trade one thing and not the other. Most of us have started with futures, so they have implicit leverage. They're very efficient to trade. The market that we trade, they are liquid, so no or very little market impact. Now, the ETFs have fees. There's a total expense ratio that you pay for trading them. So if you hold them for longer periods of time, there's a cost associated with that. Commissions are different for cash equities trading or ETF trading as opposed to futures. But of course, there could be benefits to trading ETFs to get exposure to, say, sectors or more specific areas of the market if that is what you're after and what you're looking for.
Yeah. Any thoughts, Jerry?
I agree with all of that, and I'll just concentrate on a slightly different angle. It could be possible that there's an ETF out there that is not a futures market, possible. But I would just say, from my point of view, an extremist point of view, that it's always better to trade the individual market than a basket, an ETF, an index. It seems to me that applying the trend following systems, long and short, sizing the positions based upon a particular market's volatility, following the prices and those signals of each individual market and how each individual market is working is much better, more diversification. Some of the things in the ETF, you may want to be short, long, flat, whatever. So there's no reason that I can think of that it would not be superior over a long period of time to trade the components inside the ETF instead of the ETF itself.
Agree with that fully.
Yeah. No, I agree with that completely. Yeah, absolutely. Well, we got more questions, but we won't take them today. But I can say that we had a great question from Dave coming in, which relates to some of the turtle stuff. So I'm sure Jerry will have some very interesting thoughts on that. But let's keep that for another day. Quick update, really, on the industry. We're actually recording this on a Friday evening, because of some travel issues on my side tomorrow. So the numbers I have for September so far is actually so at the end of yesterday, Thursday, and it looks like not too much changed in the industry, although I think that as Moritz said, they had a good month. It looks like we're having a good month. So, but the industry actually looks like it's down a bit, about 1% for the SocGen CTA index, still down just shy of 4 for the year, and the BTOP 50 index seems to be flat for the month, at least at the end of Thursday, and down almost 3 for the year, but not too bad. Anything else, guys, that you want to bring up before we wrap up for this week?
All good here. Nothing more.
Yeah, that's it.
That's it. All righty. Well, on that note, we will wrap up this week's conversation, and we hope you've enjoyed it just as much as we enjoy making them for you. And if you did, please share and please leave a rating and review. It really does help us grow the audience. So from Jerry, Moritz, and me, thanks so much for listening, and we look forward to be back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.